Welcome to the Dividend Talk podcast, episode 121, quarter three earnings roundup. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to discuss the final week for us of earnings, go through some of our favorite US and European companies. All that and more. See you on the inside. Hey, European DJ. Another episode of Dividend Talk. How you doing?
Definitely. Well, to be fair, we always say, it's going well, but I'm bloody frustrated because I didn't buy stocks for like almost a month now. I still wanted to deploy my cash from October by the end of October. I didn't do that. So maybe I'm timing the market. I don't know. But I have 5 purchase orders outstanding. And usually 1 or 2 get triggered because I do them like, between 2 and 5% range, like if it's not a price yet where I see them. And everything just went up all the time. So I'm really frustrated that I have not been buying things. And this is sometimes where I feel like in these moments, like, I'm penny wise, pound foolish, right? But I also need to remind me that the way I'm doing this, buying stocks already for 7-8 years, always there was something that triggered my price almost. Yeah, it happened once or twice before that it was not in a month, I guess. So I'm really frustrated. And what makes me even frustrated even more is the Snap-on. Yeah, they just did a dividend hike of 14%. And I was this close buying it like several weeks ago. So I feel so frustrated, and I'm just so much waiting for this dead cat bounce to end, and that we get like again a 10% drop, or 15 or 20 or 30 or 40. I think with 50 I might feel a little bit nervous, but the 40 would be good enough for me to really accumulate some good shares.
You've seen that. I'm guessing you've seen that overlay that people have on Twitter around the correlation between 2008 and what's happening now. You've seen that, yeah?
So, I've seen it like 3 months ago. Yeah.
It actually popped up on my feed again today, or actually not on Twitter. It showed up on TradingView today, and so it's still actually intact. It's still following that trend. So we're on that dead cat bounce, like you're saying. It's getting near the top of that, and then if it's going to follow, then we're going to just fall off the cliff pretty soon. But it's interesting. It's still following it. But speaking of Snap-on, what a record they have since 2012. This is double digits increases every year for the last 10 years.
It's amazing. It's amazing. I mean, if you talk here about a compounder with a shitload of money on their balance sheet, right? A really healthy balance sheet. I mean, we spoke about the other day. They're selling some drills.
Yeah, it's crazy. It just shows you how well managed you are. And I mean, when this company was first brought up to us, remember we dismissed it. You called him strap-on, and we ignored it. And then we got a load of messages. We must have got about 15 messages that day saying, "Lads, look into this company. You're writing them off too early. Look into them." So we did. But I mean, look at this: 14%, 15%, 20%, and now 12% increases.
Yeah, so I put my buy order, just full disclosure, at $216. That would give me a 3% yield. It's ticking all the boxes then. So yeah, let a crash come. I believe it's now trading at 226 or 227. So it would be a 4 or 5% drop. Should be possible, right? I think it was trading there before earlier this year. So 216, baby, give it to me.
It will get there. It will get there. There were some other dividend hikes, actually. I know we did this last week. We had a little section of that. We might just start off with that. Seeing as we're on the topic. There's a couple of companies that I've mentioned on here before that I want to keep track of. So one of them is CCOI, Remember I explained they're kind of like AT&T, but a more private base. They have a smaller customer base, more business. They have had their 41st consecutive quarterly dividend hike. This one was 1.1%, but that's 10.8% year over year. I mean,
Wow.
they're one to watch, but I mean, they are increasing their debt load in this environment as well. So it's going to be interesting to see how they navigate through this kind of high inflation environment. Cognex, which is another one that I've mentioned them last week as well. They had a 7.7 hike, which is good. And EOG Resources, I don't know if you recall them, they are into in the oil business, and they have had a 10% hike and another special dividend. I mean, these guys, this must be their 5th or 6th special dividend in the last 2 years. They are really, really focused on giving back to their shareholders. They've made no secret of that. I can't say a whole lot because I cover them for Sure Dividend as well, and I write a report on them, but it's a top quality company that I wish I bought when it dipped to 100. I was like you, penny wise, pound foolish. I had a buy order in at 95. It dipped to 97, and now it's something at like 140, and they're giving out this. So it's a shame, but a nice company to watch.
Yeah.
Any companies on your list that you see?
Yeah, for instance, ConocoPhillips. It was a darling, actually. Let's say in around 2014 in the dividend community. Really many people loved it because it was a spin-off, I believe, from Phillips 66. And I believe ConocoPhillips is really the upstream part of it. And then with the oil glut in 2015, 2016, they cut the dividend by 60 or 70%. And they've been now hiking the dividend. And it's insane. Another oil major that is having too much cash on the balance sheet. So they hiked their dividend again with 11%. So, and I mean, when the dividend, let's say, was I think in the low 70s in 2015, it went to 20 or 30, back to 43 last year. I think it's now, what is it, 140 or something like that. Plus, on top of that, again, 10% dividend hike. So probably it's like 150 per quarter, I guess. I mean, I don't have the exact data here, but it's crazy. And then you see just how I mean, in oil companies now, if you're working there, you're swimming in cash, and cash is literally flushing against the walls there, like these huge waves that you can surf on. And I mean, I can't imagine anything different that if you work, for instance, in Schlumberger, that you're having these parties now, like in the Wolf of Wall Street, where they're throwing midgets on a bullseye or something like that. Yeah, I mean, this is what I imagine now in these kinds of companies. I mean, they don't know from craziness what they need to do with the cash.
Yeah, but we do know that they are cyclical. So I'm sure there's a part of them while they're having wild parties, there's someone there in the background saying, let's hold a little bit of cash here. We're going to need this. We're going to need this.
I wonder if there's just one employee in Schlumberger that thinks like that, really. Come on, you must be a driller really to think like that. Anyway, the next one is Simon Property Group, and this is always in memorial of our big dividend Dane, right, who passed away during COVID. They hiked the dividend by another 2.85% to $1.80 quarterly per share. Already the third hike this year, right? Currently yielding 6.6%. Sixth one that we are talking about here is VF Corporation. I believe this is a speculative stock, dividend stock, I would say. It became a dividend king, 50 years of hikes. It hiked by 2%. I know that there are some people really loving this stock. I'm not touching it. I don't understand the business well enough. So, treat this one carefully, I would say. It's not one for the lighthearted.
No, it's not. They're after dropping in share price nearly 50% over the last couple of months, and I'm going to own some of these shares because I have a put outstanding. But I mean, look, 50 consecutive years dividend growth, and they're a speculative dividend company. I'll take that. I do like the company. they have navigated well over the last couple of recessions, but I don't know, they're starting to increase their debt load, and we'll see how they navigate this. But I will more than likely, unless I keep rolling like Limp Bizkit, just keep rolling.
Yeah, exactly.
I'm probably going to own these, but we'll
do
see
you think Limp Bizkit was an option trader?
I think so. I think he was selling puts. I swear, I think he was.
I covered calls. Maybe he was a dividend investor. Who knows?
Yeah. Hey, Fred Dorset, are you a dividend investor? Let us know.
Yeah, we should ask him on the show, invite him on the show, and ask him like, hey, you know, with this song you inspired so many of us. Yeah, but maybe one more news of the week. Yeah, because I'm often talking, or not often, but I'm often, when we get the question about our failures, I'm mentioning Tupperware. This week they announced their earnings. You need to know that I think I stepped in at the time probably around $60. I sold, I believe, in the 40s. It was where I threw in the towel. I thought, okay, this company is damaged. There was the classical value trap for me. I had to learn that. I might still have value traps in my portfolio, but you know, we learn from failures, right? It's now trading at $4 or something like that, or $4.50, after a 42% decline this week because of the earnings miss. The issue is here now is that the board of directors is not sure if they can meet the covenants, the bank covenants here. And this is a good reminder that if you think like it's too late to sell, if I would have held on to this, I would have lost another 90%. Yeah. So that's why I wanted to really share this. Like, it's never too late to sell garbage. If you figure out it is garbage, sell it. Don't wait. Don't try to wait until the share price recovers or something like that to your price that you're anchored at, because that was your buying price. Just ditch it. Yeah, I know it's really difficult. I speak easily about this now. If it happens to me, I struggle with the same thing. So at that time, I also hope that someone reminds me, like, just ditch it. Remember about Tupperware. Yeah. So it was for me really, I mean, good to read this, that, you know, this worth selling. And eventually, if you think about Tupperware, it was a top brand in the 60s, 70s, like half a century ago, right? It's maybe like how we now look at Apple or something like that, or these kinds of brand attraction it had. Yeah.
But easily copied, let's be honest. Easily copied.
I think it is not so much about the copying. I think is that this whole, you know, being with women at home, this culture has disappeared, right? My wife is not having these kinds of parties that were really popular like 10, 20 years ago. No, they go for a drink to the restaurant all together, and they just feed themselves all the time.
Maybe one more piece of news before we leave, which is, and I'm curious to hear your thoughts. I hear the biggest shareholder in Castellum, we know your love of Swedish stocks, he's looking to cancel the dividend right now.
He is recommending to cancel the dividend. And this is probably really good news that you mentioned that about Castellum, because I went big on this year. So I consider myself also a large shareholder with my few shares, because it feels like that for me. So I'm not really happy with my fellow shareholder mentioning this. And I do hope that the CEO is not listening to this person a lot, and that he really lives up to his commitments. I think, I mean, the current CEO, Rutger Anholt, I believe, had to sell shares to this largest shareholder because of this other business that he was running. What an idiot. And I think this shareholder, he seems to be like the Warren Buffett of Sweden or of the Nordics, right? I think he smells blood, and he knows that if Castellum would cancel the dividend for a year, that this price can easily drop another 30 or 40%. And guess who will be buying? He. So for me, this is kind of like price manipulation and such. I really doubt about his motives. I hope that the CEO will not bend for it, because then he puts me into a difficult space. I see from the numbers, I see no reason at all at the moment that Castellum will need to do this. The dividend is safe, in my opinion. Of course, it can change, but I still feel like they can cover. It's well covered. So why do this?
It's hard to get a feel of how much influence he actually has over the company, or how much of an influence. If he's the Warren Buffett in that area, maybe he demands a lot of respect. We've seen it even in Europe and US. We can see guys like this influence. So I mean, it's not beyond possibility.
No, and it's a risk that we need to take into account. But I'm also already thinking today, like, would I sell if this happens? If the dividend cut is not because of fundamentals, but because of greed, and therefore someone want to buy, maybe you should follow this largest shareholder with buying, right? Here. I don't know. Maybe someone has a good idea that is listening on the podcast.
A tough spot, but we'll see. We'll see what happens. We'll follow with it closely.
But it's good time to think now about what you would do with your shares, because then once the action happens, you can make rational decisions and less out of emotion.
Yeah, sounds like a video idea for your YouTube channel. Just need. Okay, earnings. This is the third week of earnings, so we'll round up some good companies actually this week.
Yeah.
I'm going to start off with a company we spoke only about once or twice. It was brought up. I think there's a lot of interest in the company because a lot of people have asked us to mention these a lot more, which is MDLZ International. We know that they're the snacking company and how big they are. What's interesting is obviously their revenues has increased 8%. A lot of that is because of hiking their prices. So they've only increased their volume by 7%. The rest of that is coming from their price increase. We do see them pressures on the other side, which their cost has gone up, which again is due to inflation. With that, obviously offsets their bottom line. Free cash flow is pretty much flat year over year. I think it's down 0.2 billion, which is not too bad, but they do return 3.3 billion to shareholders in terms of dividends and share buyback. So quite good. Looking at it, what I did like about this is the first time I actually read through their reports, and they have everything in black and white. We're going to discuss later. There's some of them not so easy to follow, but they give you the information straight away, and they explain each line item one by one, what affected it and what didn't. Currency is obviously there, inflation, interest rates, the usual, but overall looks quite solid. Probably on par maybe with say Unilever, I think, in terms of what they achieved, and nothing unexpected. I think they're holding their own. They did do some acquisition as well of Cliff Bar acquisition. I don't know a whole lot about the company, but they're expecting this to create a 1 billion global snack bar business, which is quite, I don't know if it's ambitious, but it seems quite big, and something to watch. But overall, if I was a shareholder, there's nothing in there that would alarm me. There's nothing in there that's brilliant either. It just seems to be a steady year, and as I said, quite expected for this type of company.
Yeah. Nice one. I mean, I remember that they wanted to buy Hershey not too long ago. I was just happy that they didn't as a Hershey shareholder. Okay, cool. I think it's one of those stocks that is a bit underrated. And for us, it's probably also because it's not so much on our radar. We have already Unilever, there's Procter & Gamble, then I also own Ahold. So for me to really study more consumer staples is kind of a waste of time because I don't want to diversify further into it, right?
Yeah. You don't need to. That's the problem.
Yeah, that's the thing. Yeah. Good. So I want to bring also, I mean, I don't want to sound like complaining because I started with frustration, then about this, the Tupperware. But Fresenius, have you ever read their reports?
Once I did.
So I'm getting annoyed here with them. So net income declined 15%, and in constant currency between 19 and 22%. It's a fifth of their net income that they lost. Sales grew 5% in constant currency, but even earnings before interest and taxes declined 70%. Even if you look at the full 9 months now, they are in a decline of net income on 10%. And what was really interesting in the earnings report, which caught me by surprise, they started just rambling about the Ukrainian war and the Russia war, that this is driving inflation, da-di-da-di-da. And then when they get to the to the further clarification, right, it feels like they're just trying to use all kinds of external factors to create smoke and mirrors to really, just try to avoid to show how shitty they have been performing. And this is what annoys me here, because their quarterly report is hard to read. Yeah, it's hard to get to the essence of what it is. So they have healthy organic sales growth that they say, but there's ongoing margin pressure. And they had this whole story around inflation. Why would they write a whole second page full of this, right? That something is coming up then. And I think this is just what they're trying to find their excuse. And that's the issue, I think, with this business at the moment, because they're operating hospitals and such, right? And then they have also Fresenius Kabi in there. I think they just don't have a path to growth. And I think we're just talking here about a broken strategy, a broken story. And I think that's the issue.
It's like they have three different businesses under one, isn't it? And
yeah, it's a bit of a holding.
Yeah. So it's a bit of a holding company, but even from that, you don't get a real sense of which one is underperforming here. What's dragging them down? Is it all three? And if it's all three, surely there's mismanagement here, because they're in a broad spectrum across the healthcare sector. So not all of them should be performing badly. Even when you look at the likes of other companies in the healthcare sector that are doing quite well in this environment, I don't understand it. I'm looking at it. They have a cost and efficiency program. What are you talking about? You're losing money hand over fist. What money are you saving here? What are you actually doing? There's no point in telling me you're saving 150 million per year when you're losing 150 on net income.
But they're not they are still profitable, right? What I'm trying to say. So what is tricky with this company when you organize it and when you analyze it, they also own a large part of Fresenius Medical Care. And Fresenius Medical Care got slaughtered this week with really poor earnings, and that cascades also into Fresenius. So it makes it really hard and to digest the numbers here. Yeah. So we need to be aware of that as well. But we read a lot of annual reports, quarterly reports, and we start to develop kind of a bullshit radar, right? With this, and this feels like they're trying to hide the essence with a lot of poetry around it, victim loop behavior. It's the war, it's Ukraine. No, fuck it. Everyone has this, yeah, and nobody needs to write 1 or 2 pages about this in their earnings report. I'm not even talking about a glossy annual report of 200 pages. So that's for me the issue with Fresenius at the moment. I'm happy that I caught kind of this bullshit lingo a little bit earlier, because I sold it. When was it? In my May cleaning, I believe, because I was following it then, reading a bit. And I think if you're a Fresenius shareholder, and we know that our friend Phil has this, probably, at least it was his largest position. Not sure if it still is, but I think these are difficult times. You could think at it like maybe it's an opportunity, but I don't see anything that makes me think like even that there's a turnaround plan. There's a cost-cutting strategy, but not a clear path to growth. So for me, that is probably a broken company at the moment.
Yeah. A lot of it is around cost cutting and savings. I think they have FME 25. Again, it's about savings. You don't get a sense. I agree with you. You don't get a sense of growth or what they're doing. And look, if it's the medical care business that's pulling it down, they should just state that in black and white. Just tell us, and you might forgive them a little bit. But it's so reading this. I'm only reading snippets here, but reading this seems so much more difficult than reading Mandela's or CCOI, which I mentioned earlier.
Exactly.
They didn't sugarcoat anything. This is the numbers. This is what it means. This is why we didn't meet our target or whatever, and you move on.
Yeah.
Good. I might talk about another darling of our dividend investing world, which is Realty Income. Again, I think you bought more shares in these recently, but what can we say? 100 consecutive quarterly dividend increases, which is quite something, isn't it? 100 increases. So what more do you have to say? Again, quite straightforward month for them. Their occupancy 98%. They are still increasing their funds from operations. They are expanding into Europe, which is quite interesting. The only thing I didn't really get a sense of is where in Europe. We know Europe is quite complicated. We got UK, we got France, we got Ireland, we got Netherlands, all different rules, all different markets, Germany. So I'd like to get an idea of where. I couldn't find it. Now I only spent a half an hour. I couldn't find it in this report, but I'm sure it's somewhere. But other than that, it's quite straightforward. Decent month there. Did increase depth a little bit as well, but they are investing heavily, as we said, in properties, both in the US and in Europe.
I quickly looked it up. They have 8.7% of their total portfolio annualized contractual rent from the UK. They have 151 properties there, and they have 43 properties in Spain, which is less than 1% of their contractual rent. Okay. So it's Spain and the UK mainly.
Sweet. The UK market is somewhere I can understand. The Spanish market I don't know too well, but I believe from some of the conversations in dividend day, real estate in Portugal and Spain is not maybe as
or you just have a board member there that wants to retire in Spain and still have a side hustle and does it under the Realty Income brand. Who knows?
Hey, fair play to him. But look, 100 consecutive quarterly dividend increases. That's the news for this company. It's quite something.
It's a milestone. I'm really, really a happy owner of Realty Income, and it always feels a little bit expensive, but rightly so. It is, I believe, my 14th or 13th largest position. So it is already relatively meaningful. I'm really happy with this. Nice one. Also great earnings.
Yeah. And one thing that did strike me actually is that the rent recapture rate was 108%, which is something that I think that's something interesting. So they're losing rent and then they're re-renting it out to maybe new clients, but they're
at a higher rate
than what they would have got. Yeah. So
it's a little bit what we do sometimes, right? When there's a dividend cut, I remember with Disney, it had like a 2-point-something yield, and then we sold it, and I bought Chubb for it back with 3% yield, right? And a growing dividend. It's a little bit similar.
Yeah, it's exactly the same. It's just one with stocks and one with houses. One with property.
Exactly. Okay, cool. So, next one that I want to talk about is Starbucks, and you need to give it to Howard Schultz. Yeah, what he is doing with this company. I mean, I start now to doubt if any CEO after him can step really into his footsteps, because they had Kevin Johnson before. He went full into shareholder rewards via massive buybacks, loading up really on debt. In my opinion, he got kind of kicked out by Howard Schultz. He started to focus again on what they call partners, effectively the baristas, right, that are making the coffee to satisfy them, fight the unions. In the meantime, you see numbers coming back again. So in this case, revenues up 3%. They say 11% on a 13-week basis. This is what this, like Ahold has the same right. One time a year as 52 weeks, the other time 53. Same here with the quarter. Comparable store sales up 7% globally, 11% in the US. So I assume that in the US they were really able to charge higher prices. I sometimes wonder when this stops, right? At a certain moment, I can imagine you reach a threshold with your coffee price that you get that the competition is really undercutting you everywhere with still high quality coffee, because they don't need those profits yet to reward shareholders, right? So there must be somewhere a threshold, but seemingly They have so much brand power that they can still do this. So EPS 76 cents, good numbers. If you would have this, let's say 4 times a year, you're talking about $3. For me, I'm really impressed with really good numbers, and they also gave guidance. So listen to this. They expect comparable sales growth next year to be in the range of 7 to 9%. They are also expecting to expand their store footprint in China with 13% next year. And China is already large, right? It's already quite massive there. They will also return to a buyback program. They want to return 20 billion to shareholders in the next 3 years between dividends and buybacks. And they are expecting an EPS growth next year of 15 to 20%. These are numbers that you usually see for growth stocks. Yeah. And they were also doing this, but it was mainly financial engineering the last few years. Here, it's really, at least from what I've read and what I'm seeing, this is more organically. And that's the impressive part for me in this report. I believe that the stock price got rewarded today by an 8 or 10% jump. Rightly so, because they hit the nail on everything here, including a really bullish guidance in this environment, right? We're talking in an environment where you get hit left and right all the time. So really impressed with this report of StarBucks. I'm happy that I bought some earlier this year when Howard Schultz stepped in, or just before that time or something like that, when it was around $70. And I'm glad that I finally was able to buy some.
Yeah, I remember you saying back in June, maybe was it June or before June?
Yeah,
you were talking about buying some, but I mean, they are some big numbers to be throwing around for next year. They're expecting quite a big year. It'll be more than interesting to see if they can meet those targets. But China, we know they have a big footprint there, but it's a huge space. So
through that,
they seem to have the brand power to go with it. So it's more than possible.
Just checked. I bought them on 12 May for $69.
Nice.
So it was a nice buy. 3% yield now on cost. So I'm really happy with that one, because I'm so structured to that, right? To my entry yields. So I'm really happy with that one.
Nice. I'm just going to cover Vonovia quite briefly. Nothing too in depth. I sold these at the start of the year. We know, Germany, that market seemed to be under a lot of pressure, and I didn't understand it a whole lot. So that's the reason I got out of it. But just because I know a lot of our listeners have Vonovia, we looked at them a little bit. The organic rent growth was up 3% or 3.3%, while the vacancy is still quite high. It's 2.1%, which is their record on history. So it seems like they're, I won't say struggling. 2% is not the worst, but it's certainly concerning if it's going to keep increasing. Their rent collection remains quite high, and their funds from operations is 1.98. Looking through their highlights, they have no larger value lost than expected, so they actually think everything is going to plan, and they're actually quite bullish for next year. I think they're going to stabilize and start growing. They do generate a lot of cash, and they state this here. They actually have it called free cash, 2.8 billion, and they return a lot of that as dividends. And after dividends is paid, they reckon they'll have about 1.3 billion cash on their books. Looking at their individual segments, so their rental segment, as I said, they said it's stabilizing. So you can see that in the numbers are quite similar to this time last year. So they have got a stable base. The value add segment, higher expenses is kind of absorbing that a little bit, and their development markets, that's probably the biggest one. We're starting to see increased volume with healthy margins there. So overall, I didn't really get a sense of a lot of what people have been saying, particularly in our chat or what I'm reading online. I've seen a lot of negative talk around Vonovia. I know they are increasing their debt. I know they're doing some things with their shares and diluting as well, but I didn't really get a sense from this report, reading through it, that there was anything wrong. They seemed quite content, quite happy that they stabilized, and they're expecting a little bit of a better year next year. My problem is I don't understand the German market a whole lot. I understand the Irish market, which is quite different, and I'm a little bit comfortable with the UK market. But Germany is more different. The rules, speaking to Phil that we talked to before, there's a lot of bureaucracy, a lot of different things going on there. So that's why I got out of it. But I think the market liked it. I think they jumped up as well, a couple of percent today as well. So I think maybe people reading this will get the same feeling. There wasn't a sense of anything wrong or broken or panic to have there. So maybe that's what the market is seeing.
Good. I wish all the Vonovia shareholders with this also, a happy ride to where it belongs then. Good. And maybe really quickly last then, right? It's a stock that I always want to own but still don't own, and that's Wolters Kluwer. If people are not familiar with Wolters Kluwer, it's managing and maintaining and building all these databases used by lawyers, medical professionals, researchers, and that they pay really high license fees for it. That's Wolters Kluwer. They grow again nicely, 6% now organically, and that's over a 9-month period. Guidance reiterated. They are reaching their 1 billion buyback by the end of the year. Everything looks good here, and it feels like they're anti-cyclical, or how you said. It feels like they're not impacted at all with this. Everything that's going on, they seem to just do well. So just I'm keeping an eye on this one, but unfortunately this stock will never come to my buying range, I'm afraid. They're just doing too well. You still pay what is it, a 30 PE for it. I don't think it's worth it with the low growth numbers that they have. But high quality company, high quality business, definitely.
Yeah, you said it before, boring company. What was a paper or something going into it, but they seem to be doing quite well. No, good one. Okay, we might move on to some of our listeners' questions. I know we missed this segment last week. We missed actually talking about it, so it's nice to have some questions. And the first one is from Tim, who said he thinks we mentioned recently that energy is not the best for dividend growth. He's still in the accumulation phase, and energy is one sector he's not planning to fill. Do you think a portfolio should always have some energy for a 20-year horizon?
It depends on your goals, and let's say like that. I believe in energy. Yeah, I don't see the world being able to function without energy. So that's first of all. Secondly, I think there's an underlying question here versus dividend growers and high dividend payers. So while I'm a dividend growth investor, I accept that I have also 2 stocks in the material that produce materials for energy and such, and materials. That is BHP and Rio Tinto. So those are high dividend payers. I know there's kind of a floor, probably at the 3-4% yield, but they are generally now yielding 6-7% or something like that by the massive cash that are getting in. When it comes to oil and gas companies, you have dividend growth stocks. You have ExxonMobil as a dividend growth stock. Shell, I would also consider a dividend growth stock. You've got Chevron as a dividend growth stock. The question is this the time to accumulate it? And that's what I think not. I mean, yeah, of course, you can initiate a position. I did the same with ExxonMobil when it was at $100 like 7 years ago. I bought few shares. I thought it would never go back to 70 or 60. Well, it was 35 last year. Not sure if we will see again minus a dollar price for oil, right? But for me, I'm not now looking at energy to accumulate because it's so cyclical that there's a high likelihood that it will go down again at a certain moment. So that's why I'm not buying them now, but I do believe there's a good place for these oil and gas companies. I don't think they will be disappearing anytime soon, and I think they have so much cash at the moment that they will be buying back clean energy. And even better, if there's more scarcity in oil because people are still driving cars and such and people are moving away, then they will pump less. There will be less capital investments that they have been doing. So it's not like just because there are a few people driving an electric car that suddenly there's no oil needed anymore. Our economy drives on oil.
Yeah, no, I agree with your sentiment as well. There's definitely some dividend growth stocks out there in that category as well, and I think you're going to need energy, aren't you? No matter what,
Yeah.
no matter what, energy is always going to be there. So,
Yeah.
I wouldn't avoid it. I wouldn't avoid it, but it just depends on, as you said, the risk and what you want and stuff like that. But good answer.
Hey, we have a nice question for you from Mike Plezier. He's asking, which company is the Virgil van Dijk of your portfolio and which one is the Mohammed Salah of your portfolio?
I love it. Virgil van Dijk, I'm going to say Intel. A lot of potential, was once at the top of his game, but is struggling a little bit right now. But there's still plenty of time to turn it around, particularly before the World Cup. And Mohammed Salah, I'm going to say Microsoft. The quality is there. Their share price has dropped quite a bit over the last year, from 300, I think, down to it's just hovering around 200. But the quality is there and always delivers. So that's what I'm saying. Intel for Van Dijk and Salah for Microsoft for Salah.
Nice one. And then Val Lebowski is asking, in your analysis of fundamentals, do you look also at the size of goodwill compared to total assets?
Sometimes, yes, I do. I don't have a particular number off the top of my head, but it is something I do look at, and I like it to be as low as possible.
Yeah, I do the same. What is the best to do probably is if you look at the balance sheet and you see that the goodwill has 1 digit more than all the other entries on the balance sheet around it, it should really raise a flag. For me, typically goodwill shouldn't be more than 10 or 20% of the whole balance sheet. It depends a bit on which industry, because if you're talking about SaaS companies and such, usually they overpay for the market value at that time. But if there's a lot of cross-selling possible with that, because it fits in. Think about LinkedIn. That was probably 3/4 of goodwill in there. But look now, what Microsoft was able to do with this. So goodwill in itself is not bad. But if you go to a company that's heavily in debt and goodwill is covering, for instance, 1/3 of the debt, you're in trouble quite easily, because goodwills often get write-downs in those moments.
Yeah. Marek has asked you, why do you live in Poland?
Well, family reasons, right?
You fell in love.
Exactly. What can I say? Cost money, but lower taxes here than in the Netherlands.
We're getting a lot of fun questions today. So Robert has asked us, what is your opinion on aggressive work pressures which are in conflict of interest with shareholders' interests? For example, BlackRock pressure on Exxon, opinion on future of stakeholder versus shareholder capitalism, and Biden preaching about extra profit. I find that quite dangerous.
So this is the topic of woke. We tried to build one time a woke index, a woke ETF, right? And we have yet to find a stock. I think the Kleine Kapitalist has one that he brings up from time to time, and he has a really good case, but that's probably then the only one.
It's a sign of the times, isn't it? Look, the world adapts, the world changes. There's always, we talk about cyclical in stocks. We have that even in the way we dress, how our attitudes, all this changes over time. At the minute, there's a lot going on. There's a lot to digest. Sometimes I don't understand it. I come from a different generation. So I agree. It can be dangerous, but remember the generation coming up behind us, this is what they're going to live with. This is what they're probably going to know more than us, and it might just become the norm. So I don't know. I try and stay away from that and give my opinions. It is what it is, isn't it? It is what it is. We just have to adapt as investors or as people. You just have to adapt with it.
Maybe just really particular also on the stakeholder versus shareholder capitalism. So Danone and Unilever have a stakeholder approach, right? I'm actually a fan of that because I believe that if all stakeholders are happy, the business do well. But let's not forget that the shareholder is one of the main stakeholders, and this is where it often goes wrong. When those companies go too far and forget about the shareholder as well in the picture, who's actually having their capital at risk. Yeah, because if you annoy them, I think it's a red flag from a company. And we've seen that a little bit with, for instance, with the whole Ben and Jerry's case with Unilever, right? Here in the ownership structure there. And last thing about Biden, I mean, I keep repeating about this extra profit. Biden was not coming with, saying, because he mentioned this week, like, we're going to, they make 100 billion in profits. We're going to tax the profits. They made the big five, right? So Chevron, BP, Shell, Exxon, and Total Energies. They had a total of 76 billion loss in 2020. Yeah, it was not like that how you said, Biden said, like, send me the check and I will sign it, and I will cover your losses. And this is, I think, what I'm really against, because for me this is really, I mean, for me this has nothing actually to do with woke. There's just elections going on in America, and this seems to be
I was
important.
just going to say, I was just going to say, I think, okay, the stakeholder, shareholder, yes, I agree, and I think it's a fine line. I don't think you can keep both happy for long. There's always antagonistic opinions there.
Well, what you have here is you have like a swingers relationship, right? Effectively, while you're married.
Yes.
With one you have a contract, and with the other ones you're just swinging around.
Yeah, it's quite difficult. But the Biden thing, I always feel like these leaders, because we heard it in the UK, we've heard it in Ireland, we've heard it throughout Europe, taxing the rich, and it's always around the times of elections. I feel like they say it as in tongue in cheek, knowing they're not going to do it, but also knowing that they are appealing to those that are under pressure, because there's a lot of people under pressure at the moment. If you look through Starbucks or a lot of the reports that we've went through, most of the price increases have actually been in the US as opposed to Europe, and it's probably a trend that we've noticed. So there is a lot of pressure over there. A lot of people are probably on the breadline, probably struggling, and don't want to see these companies making a lot of money. Biden comes out and says, "Oh, we're going to tax these guys. Don't worry, vote for me, and we'll tax these guys." What will happen? He'll get back into power, and then that law will go back away. So I always feel that's tongue in cheek, because let's be honest, corporations probably hold more power over there than he does himself. So I don't believe it for a second. And I think if we start going down that road, I agree, it could be dangerous.
It will break capitalism, in my opinion.
Yeah,
and I think England already has, the UK is already doing it, right? And the Netherlands, I believe, as well. They have already said, and even Ben van Beurden from Shell didn't even fight it. I think they have peace in the fact, like, okay, we operate in this bloody country. Let's not fight it. Our reputation is already too bad. We don't want to have more bad reputation, right? But it's breaking capitalism, in my opinion, because what you're really saying is like, okay, because think about it, they're investing billions and billions in capex. Yeah, so, and there's a large risk with that. And if then there's a political movement that once you can start reaping the benefits from it, that they say, okay, but now we tax you because your oil's bad. Yeah, this will prevent investments at a certain moment, right? And that will just break capitalism. And I think we don't want that either.
If we break capitalism, we might break the stock market and we'll go poor.
Yeah, exactly. Yeah, because then we just live on other people's money.
Exactly. Yeah.
Because they will pay for us.
Dividend wave. Outstanding companies for the past 2 weeks in earnings seasons. What impressed you either way?
Texas Instruments, Snap-on, Starbucks, Microsoft.
Yeah, I was going to say Snap-on would have been mine, and Texas Instruments too. In terms of poor performance, you're probably looking at Fresenius up there with one of the worst ones that I've actually seen so far.
Yeah, definitely.
Who's next? Drip has asked us, Why Elon Musk bought Twitter? As an active user, do you see the platform future as grim, bright, or neutral? Disclaimer: if you're fed up with the topic, he says he knows we're fed up with the topic, so maybe it's a chance for us.
Well, what my issue is this week, I know they probably didn't change the platform at all, right, and the algorithms, but I don't like going to my timeline anymore. It is full with bullshit, all this stuff around Twitter and Elon Musk. So honestly, I was even thinking this week, maybe I should just move from Twitter away totally to Facebook. Because if this continues another 2-3 weeks, there's no value for me on seeing this whole drama queen and prima donna Elon Musk and all the conversations around it. So I really hope it will fade away quickly, because I'm not going to. I follow 600-700 people. I'm not going to mute 500 people that are liking all this stuff and everything. And honestly, I even catch myself sometimes replying just out of frustration, right? That I become passive aggressive in my tweets. So I don't want this shit on my timeline. So I think he brings up a good point. If this is really like the new normal on Twitter, don't expect me long there. Neither with 12,000 followers. It's no fun. I'm there to engage, not to read all the crap.
He's turned it into a bit of a circus. Really, that's what he's done. But look, we'll see. He's settling in. There's a lot of news focused on him. We just need something else to happen, so the news will forget about him for the time being, and he needs to just shut up, because I'm sick of listening to him as well.
And what a clown, right? What a clown. He buys this stuff, then he doesn't want it, then he thinks like, shit, legally I'm buying it. Okay, let's buy it. Then he has it. He starts making all kinds of free speech comments, and then the free market comes with a right, how you say it, uppercut on his face, and says, "Thank you. We'll take our advertising dollars away." There he is. I mean, come on, what a clown show.
Yeah. Okay, we'll move on. Mark
please.
has asked us, have you ever checked out ticker symbol UMG, which I think is Universal Music Group? They're from, I don't know if they're from the Netherlands, but they're on the Amsterdam Exchange. They spun off last year. Seems very recession proof, and he sees a lot of catalysts and tailwinds growth. I have to say, I did not hear about this company. I didn't know a whole lot about the company. I have looked at him on Kyfin, which is what I use as my screener, and they only have data going back as far as 2018, and they've only paid dividends last year and this year as well. So there's not enough information there for me to make an assessment of that. And as I said, is it recession proof? I don't know.
Thanks, Marta, just also for bringing it to our attention. I can really say nothing useful about it, so I have to study it one time. But let us know, really, because you say it's potential for fantastic dividend growth investors. So maybe you could give us a few reasons why. I would really be interested to learn that.
Yeah, well, they have grown their free cash flow per share over the last 3 or 4 years since they obviously spun off. So obviously they're generating cash flow. Their revenues look good, profit margins look good. So I mean, it does look like it has potential, but for me, it's just too young of a company. Not enough of dividend history there. We don't know what they can withstand or what they can't, or even if I don't understand if they have a policy of increasing that or what the policy is. So it's too young for me. And as I said, recession proof is one that I would love to hear why you think that, because I think Universal Music Group, I don't know what the company does. I have an idea based on the name, and I don't know if that is as recession proof as you think. But I don't know. I would love to hear more as well.
Good.
Gordon has asked us, he's having trouble identifying strong balance sheets. He know the metrics, but don't know what the good, acceptable, and risky ratios are.
Oh, I think we did a whole show on the balance sheet, right? And let me look up on the background which episode number that was. Then please listen to that podcast.
I can tell you what I like to do in terms of the ratios. I don't think there's a magic number for each one, because each industry is different. some industries you can carry a little bit more debt. Some you can't. Some will have very low interest coverage. Some might have more, etc., etc. One website that I found really good, it's for US stocks really. It's called ReadyRatios.com. And what I used to do is I used to check the industry average, and then check and see where my company is. And if they're in and around the industry average, I was quite happy. Obviously, if they're significantly above the industry average, there may be a problem, and then you'd have to dig a little deeper. But as I said, I don't think there's a magic number. I just think it does depend on the company and the industry, and how much you are happy for them to have on the balance sheets.
Yeah, makes sense. Makes sense. But for instance, I said debt to equity is an important one, in my opinion. When I look at the balance sheet, I also like to see how much cash they have on the balance sheet, and for instance, how much short-term debt they have. I would like to see how much of the assets are tangible versus intangible. I would like to see how much goodwill. But like you say, to turn it into ratios is a bit more difficult, because, for instance, Ahold has a lot of debt, but it's not really a concern. Yeah, because it's a slow moving. They usually have like, I said, the volatility of 1 or 2, 3%, not like 10, 15%. So really predictable cash flow, so they can easily consume debt. So, that makes it all a little bit difficult, but you can always look up the credit ratings, at least to give you a little bit of feeling, and rate, for instance, from Moody's, and read the report. Why does it have a certain credit rating, and what are the risks? Maybe this also allows you to dive then a little bit into the balance sheet, to figure out if you agree with that, right?
Yep. Okay, and Future Dividends has asked us about our thoughts. I think you sent out a tweet about, have you ever considered what will happen in your dividend portfolio after you have died? Yeah, it's quite straightforward for me. I already have a will in place. So if I go before my wife, it'll go straight to my wife. If my wife goes before me or at the same time as me, it goes straight to my kids, and that's already
Yeah.
in
But what
place.
is written here, this, I think, this follow-up question: do you feel your other half will, your wife in this case, will be able to use it, let alone even understand what it is about?
Now I think so. She's actually, I spoke to you last
Yeah.
week. I think I said on the show that she started
Yeah.
investing in ETFs. She's getting a little buzz out of this. She keeps checking it, and she's asking questions. She's reading books about it. It's actually quite amusing. And she's asking me a lot more questions about what I do. So I think there's hope.
Okay.
Certainly my kids, I'd be a lot more comfortable with them managing my portfolio than my wife at the moment. So
Yeah, for me it will be hopeless. Really hopeless. I even a will not fix it. Yeah. So
she was asking me. She was asking me do I have passwords, and where are the passwords for? And I was like, you looking to kill me off?
yeah, so I was
already?
thinking the other day, maybe I should ask one of my relatives who at least understands the little bit that I trust, to not give maybe necessarily access, but write maybe a little bit, few steps down, what to do in case, how to get access and such. But no, I think, my wife would be screwed, kind of. Yeah.
But my advice to her at the time when we were writing the will, because she had some concerns about this, and I just said, sell it all, take it out, spend the money on what you want. I mean, that's I can't expect her to do it. But to be fair, my son, who does invest himself, he knows how to work it. He actually knows how to use the platform. He'd be well able to manage it for her. He'd probably take over I'd imagine he'd take over the account for her. So.
Yeah.
No concerns.
Good. Okay, super.
I got a question on Twitter from Ronan. He has asked us about some of the best brokerages that we recommend and other tools for dividend portfolio tracking, trading, monitoring. Ideally, something that links into something like Seeking Alpha and allows drip investing.
In Europe, I can't. I simply can't.
Yeah, I don't know about drip investing. I have a brokerage account at IBRK, Interactive Brokers, and the Gyro. None of them, I don't think Interactive Brokers do anything, but as far as I'm aware, none of them allow drip investing. I don't really use tools that go into Seeking Alpha, and most of our tracking is done on pretty much G Sheets.
Yeah. I must confess that the Hero has been expanding their data sources and such, and actually, I was surprised how much relevant information nowadays you can get out of the company information. So it was a surprise to me. They've been really enhancing that, I guess, over the years.
Yeah.
But in Europe, we don't really have this stuff, Ronan. In America, it's a bit more. You have, for instance, M1 Finance and these kinds of things. They always advertise. I believe you can plug it into your brokerage account, and then it does everything for you. You can drip. And here it's usually like in the country where you have your account, you usually can drip the shares that are listed in that country. Yeah, and otherwise it's nearly impossible. So.
Yeah. Okay, and last question is from David, who wants to hear us talk about how to reclaim dividend tax, and from which countries and how and when to submit them.
Okay, first of all, this is a really complicated process. Secondly, I've got a blog post on my blog. So go to European DGI, check in the left menu, you will quickly find an article to dividend withholding taxes. You'll see links to forms and everything. What's good to know, you don't need to do this every year per country. Usually it ranges from once in 3 to 5 years. You can do this, so you can accumulate this. Now here comes the tricky thing, and I'm still waiting, for instance, for my German tax reclaim to get an answer. But for instance, I believe you go to France, you need to have a dividend certificate issued by your broker. I went to the website from Interactive Brokers, and they charge 150 or 200 euro for doing this per line item. Now you need to have a large position to get so much money deposited to make up for the tax that you are trying to reclaim. So you really need to look into some of those countries, and unfortunately there are just too many barriers. I just started the process of reclaiming. Next year I will try Sweden as an example. First country is German. It's just really complicated, and we are just hoping that within the next 10 years the European Union fixes this for us, because we know they have an intention there to fix this.
I mean, it's one of the most annoying things that we have in Europe, that we don't have this facility. It's my fears it turns people off investing in Europe, in European companies. There's some good companies. I know you preach dividend after tax. Look at the yield after tax. I know you preach that probably for this reason. So it's quite frustrating. I haven't done it. I've only done it in Ireland, which is quite straightforward. I don't know as an outsider how easy it is. It seems like it's probably going to be the same. I had a look online, same kind of forms, and everything is done online in Ireland, and it's usually quite quick. So I'd love to hear from actually someone outside of Ireland how easy and how efficient it actually is. For me, it's seamless. It's done. I find it. And if I'm due a refund, I'll get it within a week. If I have to pay tax, I'll pay that within the week as well. So it's quite straightforward, but it's just really annoying. It's really annoying. But look, we know Europe are moving on it quite slowly. We do have this pan-wide pension scheme now that they've rolled out, and they're trying. It's just a lot slower than what we would like.
Yeah, I do believe that Alan, our buddy on Twitter, I believe he is with a bank in Sweden where they were reclaiming a lot of his taxes, and he got good support and good services there. There might be some traditional banks that have a better process for this, but when you look at the online brokers, it's few bar. It's really few bar, this part.
Okay, good. Thanks everyone again for all your questions. I missed this segment last week, so it's always fun. There were some nice questions, some fun questions in there. So thanks a million for that. Pleasure chatting to you as always, European DJI, and we will
likewise
see everybody next week.